We receive many comments around the differences between 401ks, IRAs, and other types of retirement plans. Just to be clear, a 401k, a 403b, a 457, these are all company-sponsored plans. This means that your company sets up the plan, provides the paperwork to the employees, and you enroll through that company. An IRA is an individual retirement account, and this means you set it up all on your own. There's no company involved. You have to take the initiative and you have to take the responsibility for your own financial future. So how do you know if an IRA is right for you? Well, that's the topic of today's video. Hi, welcome back to Bright Wealth. My name's Scott McLean. I'm your host, and I'll be your instructor for today's lesson. As always, we're here to accelerate your financial success. In this episode of Bright Wealth, I'm going to break down the 5 basic stages of a traditional IRA so you can use this information to make more informed and brighter financial decisions. Once again, an IRA is an individual retirement account. This means you set it up on your own and there's no company involved. You are ultimately responsible for yourself and for managing it and for selecting an advisor to manage it for you. So how do you know if an IRA is right for you? Well, maybe you don't have a 401k at work. That's a great time. What if you're currently maxing out your 401k at work and you're still looking for a place to put money? An IRA is great in that instance. Or maybe you just want other investment options and your 401k doesn't provide enough. It only provides a list of funds. In all of these cases, an IRA could be right for you. So let's get started and quickly review each of the 5 stages of the traditional IRA. Okay, so let's take a look at the timeline of your life. You're going to notice along the bottom level here that you have the years of your life going from 10 years out to 130 years. And along this column on the left-hand side is the wealth accumulating over the course of your lifetime. And so this right here is the timeline of your life from early years to your later years as your wealth accumulates. And what happens for most people if they're actively accumulating wealth is that they will start sometime here in their 20s or soon after, and they will slowly accumulate wealth, maybe faster than slow, and at some point they'll plan to retire. They'll take some income and then pass the rest of that wealth on to their family. And so this is sort of the timeline of your life and how the wealth accumulates over that. And what I want to do in this next phase is show how these 5 stages of the IRA fit into that. Now let's go ahead and run 2 scenarios to better understand how the timeline of your life plays into the growth of your IRA and into the growth of your future finances. So in scenario number 1, what we're working with is a 20-year-old contributing about $4,800 a year, and they have a compounded annual growth rate of 7%, which is underperforming, let's say, the S&P 500 or a normal index. And so a 20-year-old contributing $4,800 a year from age 20 to age 65, earning about 7% a year. And for scenario number 2, what I'm going to do is work with a 45-year-old who is contributing $6,000 a year to their IRA, and they're earning a compounded annual growth rate of 7% as well, except they also have a rollover from a previous 401k of about $175,000. And what I'm going to do now is map both of these scenarios out on the timeline right here, and we'll take a look at them. So first, scenario number 1, a 20-year-old compounding would have about $66,000 by age 30. They would grow to about $204,000 by the time they were 40. They'd have about $600,000 by the time they were 470. By the time they were 60, we'll be closer to $992. And by the time they are 65, they'll be at about $1.4 million. And we can see what that would look like right here on the growth rate. Now, the 45-year-old taking money from an old 401k and rolling it over, and we're going to go ahead and load in the 175 and start compounding from there. What will happen is we'll have about $181,000 by age 50. We'll be at about $279,000 by the time we reach 60. we will be at $634,000. By the time we reach 65, we'll be at about $923,000. So stage number one is to open your IRA. Now that may not be as obvious as it sounds, but you have to open an IRA all on your own. There is no company that's going to open it for you. And so that's something you have to do, physically go out and open it. And we'll cover all of these 5 stages in today's lesson. Stage number 2 is to fund your IRA. And once you open it, it's not going to have any money in it. It's just going to be a blank investment vehicle with no money in it. So you have to actually transfer money from your bank account or from somewhere else into your IRA so that you can then move on to stage 3, which is to invest your IRA. And just because you put money in it doesn't mean that it's in the market or in the stock market. It just means that you have money in your IRA account and it's most likely sitting in cash. And so you have to invest that into some sort of investment allocation, meaning you have to buy stocks or securities and get your money growing for you. Each of these 3 stages, opening, funding, and investing your IRA, are going to start as early in your life as possible. And you want to make sure that, if you're in your 20s, that you're looking at this right now. And if you're in your 30s or 40s and you don't have an IRA, this is your individual investment account. And it's a tax-deferred investment vehicle that's going to grow your money. We're going to talk all about it, but you want to have them open as early as possible in your life. Once you've got it open, you have funded it with money and you've created an investment allocation and bought your investments. Now it's time to grow your IRA and to really monitor it and grow it over the course of your accumulation years. And that's from the time you open it or as early in your life as possible till the time you're going to take income, which is the final stage. And that's going to happen, at some point later in your life. But during these accumulation years, you want to be monitoring how your IRA is doing. And so that's really the subject matter of today's lesson, is that we're going to work through each of these 5 stages of the IRA and figure out what you need to be doing at each stage to maximize your investment, to capture the best possible return for yourself and protect yourself and protect your investment from any sort of market risk the best that you can. And so let's go ahead and take a look at stage number 1 and really start digging into the different types of IRAs that you can open. So let's go ahead and take a look at stage number 1, opening up your IRA. It's not going to happen on its own. You're the one that has to go out and open your own IRA. The question is, what type of IRA is best for your situation? Did you know that there's 4 different types of IRAs that you can open? Today what we're going to do is take a look at the first type, which is known as the traditional IRA, and that's going to be the topic of today's video. There's also another type of IRA known as a Roth IRA. And a Roth IRA is named after the late Senator William Roth, who introduced a tax-free income option into the retirement space in the late 1990s or so. The Roth IRA is an excellent option for many, and we'll have a separate video on that in the next week. The third type of IRA that you can open for yourself is a SEP, known as a SEP, and that is the Simplified Employee Pension. And these can be incredible investment options for small business owners who have a family or friends working for them with a small staff. You can put a lot of money away into this type of an IRA. The contribution limits are much higher on a SEP, and it's great for maximizing tax-free growth out of your money. And the fourth type is a simple, and many people don't know about this type of an IRA. It stands for Savings Incentive Match Plan for Employees, and it's kind of like a 401k, but it's technically an IRA, and it's for business owners that have employees under 100 employees and want a lower cost option than a traditional 401k. There's different limits and contribution limits and rules to each one of these IRAs. So what we're going to do is go into each one of them in separate videos. If you look at the traditional, the Roth, the SEP, and the simple, you'll notice that, on a traditional, just really quickly, you can put on average $6,000 a year. You can contribute on average $6,000 a year to a Roth. You can contribute over $50,000 to a SEP, And you can put about $13,500 into your simple. This one right here, a Roth, is going to grow tax-free, and it's also going to be after-tax dollars going into it, meaning your money is going to come out tax-free when you take income. So here's a question. When you're ready to open up an IRA, where do you go? You have four main options and four primary places you can open up an IRA. Let's take a look at each one. The first and most common place that people open up IRAs is at their brokerage account. And so that could be at TD Ameritrade, it could be at Charles Schwab, it could be at Morgan Stanley, it could be at any one of the major brokerage houses. It could also be here at Bright Wealth. You can schedule an appointment with us and we can open up an IRA for you through our Bright Advisor team. The second place where you can go to open an IRA, which is a common, is the bank. And so at any major bank, they have usually a financial department that can open up, some retirement accounts for you. But they're not the best at managing your IRA. They're pretty good at opening them up for you, but banks are best at banking. Credit unions are another option. You can go to your local credit union if you belong to one, or you can go to a savings and loan. And so in each one of these four cases, you can pretty much get an IRA open and contribute money to it and even start making your investments and growing it. My option, my best bet, is to use a brokerage account, and I think the number one is Bright Wealth. Okay, let's go ahead and move on to funding your IRA and talk more about how we do that. When you first open your IRA, it doesn't have any money in it. It's just a blank investment vehicle. You need to put money into it and then again, ultimately invest that money. And so there's two primary ways to put money into your IRA. The first way to fund your IRA is through annual contributions. The second way is through rollovers and transfers. So let's go ahead and take a look at annual contributions. When you're contributing to your IRA, you can have a certain amount of money that you can put in each year. The minimum amount that you have to put into your IRA is zero. So when you're talking to financial professionals out there in the finance space, or friends, family, whatever, if they're not securities licensed, they might be trying to open up insurance policies for you as part of your retirement vehicle or part of your retirement account. And if you're using insurance as your retirement, then there's going to be a required monthly minimum every single month that if you're saying, I'm going to put $300 a month in my account, you have to put $300 a month every single month into your account. Otherwise, you could collapse that insurance policy. So I'm just going to caution you, when you come to a retirement account that requires a minimum amount of money each month, you want to make sure that you double check that with your financial advisor before you purchase something like that. And I mean a licensed securities professional. So when it comes to an IRA, an individual retirement account, there's no monthly minimum. You don't have to contribute. If you end up having a lot of expenses at home one month and you don't want to put the $300 into your IRA, there's no sweat, there's no worries, there's nothing at all. And so that's the minimum. On a maximum, under the age of 50, you can contribute up to $6,000 a year. So for this type of a vehicle, an IRA, you can put up to $6,000 a year into your IRA. The maximum that you can put if you're over the age of 50 is $7,000 per year. And so you can put a certain amount of money in. That money goes in pre-tax. And you have a deadline though. Each year you have to put your money in every year or you miss that opportunity for that year. And so right now we're in the year 2021. Your deadline is April 18th of 2022. And so as long as you have your money, as much as you want to put into your IRA by that deadline date, that will count for the 2021 year. Now, things to consider when you're contributing into your IRA. Do you want to contribute it all at once? Or do you want to contribute it periodically? And that's another option that you have. So if you have money set aside over in your brokerage account or in a savings account and you just want to put the $6,000 for the year in, let's say on the day after tax day, April 23rd, and you put all your money in, that's a great scenario, and many people do that because then your full amount in that IRA is compounding all year long. If you're making monthly contributions throughout the year, then you're slowly adding money to your account and compounding the bigger amount by the end of the year. Now, so you have an option, all at once, periodic, there's no set schedule that you have to do. Your money that goes into your IRA is going to come out of ordinary income or earned income, and your contributions are going to be tax deductible. We're going to talk about that in a minute, but what that means is that if you put money into it and if you earn a certain amount of money, that money is deducted off of your ordinary income for that particular year. Now, if you earn over $66,000 in a year, let me go back. If you earn under $66,000 a year, then 100% of the money that you contribute to your IRA is tax deductible. For example, let's say you made $66,000 in a year and you contribute $6,000 to your IRA, then as far as taxes are concerned, you will only have earned $60,000 for that year. And you guys can see that right here, down here. So by making that contribution, not only do you get money into your IRA, you actually lower your amount of money that you earned that year by that contribution amount. Now, if you go over $76,000 a year, anything between 66 and 76 will be partially deducted off of your current year's taxes. Anything over 76,000 as an individual putting money into their IRA will be able to go into the IRA and compound and grow in a tax-deferred environment, but you won't get the credit on this year's taxes. So that's the difference there. And so if you're married, your limits are a little different. You're $105,000 as a married couple filing jointly. And if you earn as a married couple jointly filing, both of your salaries added up, total income for the year is under $105,000, then the full amount going into your IRA will be tax deductible. If you earn between $125,000 married filing jointly and above $105,000 and under $125,000, then your amount will be partially deductible. And if you earn as a combined couple over $125,000, then again, you can put money into your IRAs, but you cannot get the tax deduction on it for that particular year. Married couples also have a unique situation that if only one spouse is earning income and the other spouse is not, you can still contribute to two IRAs. So a married couple under the age of 50 could technically contribute $12,000 to their IRA instead of just the $6,000, even if only one spouse is working. And that's a great way to get more money growing for you in a tax-deferred environment. Now, that is the way to contribute to your IRA through annual contributions, $6,000 a year or $7,000 a year per spouse or individual, and that happens year over year over year. If you have an old retirement account that you're no longer working at that company, you can also roll over or transfer that balance. And the four most common accounts that you can roll over or transfer to your IRA are a 401k, a 403b, a 457, and other retirement savings plans. Now, these four types of retirement accounts are great for transferring money or rolling money over into your IRA, but there are some rules. One is that you're no longer employed at that company. And so as long as you're no longer employed there, you can transfer that balance over. Also important to remember that rollovers and transfers are not taxable. So if you're rolling $175,000 over from a 401k into your IRA, you're not going to pay any tax on that. And finally, rollover checks, if you receive a rollover check, that must be deposited within 60 days. Now, what's the difference between a rollover and a transfer? That's a big question that we get all the time. A rollover is a check that is actually physically mailed to you from the financial institution, and the check shows up at your house, made out to the brokerage account where your IRA is open on behalf of your name. So what that means is if you worked at a company for several years and you grew a 401k balance, let's say to $175,000 like we used in our example earlier, and that money is sitting in that 401k, previous employer, and it's just sitting there, you can contact that company and say, I want to roll that over to my new IRA that I've recently opened. And what they're going to do is they're going to mail a check to you in the name of the brokerage account where your IRA is and for your benefit. And you'll receive that check, and then you have 60 days to mail that check to that brokerage, and they will deposit it into your account. Another way to do it is a transfer. It's a very similar process. In that case, the money just transfers directly from your old 401k right into your IRA. And so that's really the or really what goes on funding an IRA. Just to recap, you can do annual contributions or you can do a rollover. One common question that we also get is, if I roll over $175,000 into my IRA this year, can I also contribute $6,000 this year to that IRA? Can I do both? The answer to that is yes. So if you have an old 401k and you transfer that balance over, that can go into your account this year. And you can also contribute up to $6,000 if you're under the age of 50 or $7,000 if you're over the age of 50 into your IRA for that current year. So that's funding your IRA. Now let's go ahead and take a look at, once you've got the money in there, investing your IRA. There's a lot to consider when making investments, including but not limited to your asset classes, your market sectors, the market capitalization, the research that you're doing, the region that you're investing in. All of this leads to the investments of your IRA. When it comes to asset classes, for example, you can put stocks into your IRA. You can also put bonds into your IRA. Another asset class that is common are ETFs, which are exchange traded funds. In addition to that, many people put mutual funds, and they'll buy mutual funds for their IRA. And besides that, you'll most likely have cash or CDs, and those are the most common asset classes that you have in your IRA. We do get a lot of questions: can I put crypto in my IRA, or can I buy crypto with my IRA? Can I buy real estate? Can I buy gold? There are ways to do that, but that's not a traditional IRA functioning in the traditional way. There are rules and ways to do that, but there are also Congress and rules in Congress right now that might take those provisions away. So we're going to hang on and do a video on that after the end of the year. These are the 5 most common asset classes that you can put in your IRA. In addition to asset classes, meaning the types of investments that you're putting in, you have the different market sectors that you can put into your IRA. One of the most common market sectors is energy, and that's the oil, the gas, solar, etc. So companies that are in oil or gas or solar fall into the energy sector, and sometimes that sector is doing better than other sectors. And so you might want to be looking at what sector or do I want to be putting into my IRA. Another one is physical materials. And with supply shortages, what would happen to the price of materials? What might happen to companies if they can't get their supplies? All of this is part of your consideration, things to take into consideration. Industrials, utilities, healthcare, finance is another common sector. You also have consumer staples, consumer discretionary, information technology, real estate, and a number of other sectors. That is the market sector. The market sector is a collection of different companies that all fit in that sector, and you then buy the individual stocks of those companies or the bonds of those companies or ETFs that hold those companies and put those into your IRA. In addition to that, you might be looking at the market capitalization of individual companies. The smaller the capitalization, typically the more volatile that company, and sometimes the more risky, but the better returns you could get. And the higher the capitalization, the more stable, well-established that company is. The different market caps are broken out into micro cap, which starts at the company's annual earnings between 50 million and 300 million. And then you move on to a small cap, which is 300 million to 2 billion. You move on to a mid cap, if it sounds like mid cap, between 2 billion and $10 billion. And then you move from a large cap from $10 billion to 200 billion. And anything above 200 billion is going to be your mega cap company. These days, I think we might even need a new category. I don't know if we're going to call it ultra mega cap, but maybe 200 billion to the $1 trillion company. But that's new. Right now, these are the market caps that you would be looking at in your IRA. And so the next step after figuring out what your investments are going to be and doing your research on these companies is to actually grow your IRA and monitor it and make adjustments to it over the years. So let's go ahead and move on to stage number 4, which is to grow your IRA. Growing your IRA takes attention, and it's something you're going to do over the course of your lifetime. Now, you're going to have to make a decision when it comes to growing your investments. The question is, are you the type of person that loves managing your own investments, or do you want to have a professional who does this for a living manage your investments for you? Well, let's take a look first at the person who loves to manage their investments. This type of person loves to do research on different stocks. They've got their own investment philosophy. Maybe they have an investment strategy and they understand their horizon. They're all in tune with the emotional and mental fortitude and everything. They love this stuff. But the average person who's opening up an IRA is not necessarily going to feel so comfortable with self-managing their IRA. So let me go ahead and walk you through some tips to help you better understand it. The first is that you're going to have to know your tolerance for risk. And that means how risk adverse are you when it comes to tolerance for risk. Let me spell this out. Here we go. How adverse are you to the market swings on your account balance? And so if your account goes down $20,000 off of a $100,000 balance, are you comfortable with that, knowing that the other side of that is that you could earn $120,000? So you're okay with these ups and downs. If that freaks you out, then you have a lower tolerance for risk. If you're more comfortable with the ups and downs and you're excited about the potential upside with your investments, then you're more of an aggressive investor and you have more of a tolerance for risk. You're going to want to understand your tolerance for risk. You're also going to want to know your timeline, your horizon, your time horizon. And so we're going to write time horizon right here. If you can't read that, that's okay. Just know that that's the word that I'm attempting to write on the iPad, time horizon. And that really means how much time starting in the beginning of your life, down here, do you have, and then ultimately going across your life over here. What's your time horizon? If you're 20, then you're starting right here, and you have all the way until you're 90, until you're gone. So this entire spectrum is your time horizon. If you're starting your retirement account right here at age 45, and you're starting at 0, and you're hoping to retire by 65, and then you have a very small time horizon. So you want to understand this horizon so you know how much time you have in order to achieve your goals. That's going to shape what type of investment decision that you're going to make. Okay, next we're going to look at choosing your investment allocation. And that really is, I'm going to write this out here again. You might not be able to read my writing. I swear I did not take doctor training. This is the iPad. That says investment allocation right there. And what that means is what percentage of your money is going to be in stocks, what percentage is going to be in bonds, what percent is going to be in certain sectors, creating that investment allocation like we talked about in the last stage. And so what's your allocation and understanding what do you want to create for yourself? So next what we're going to have to do is we're going to have to research, pick, and buy your investments. And so that means, and that's an emotional time for some people because you're actually taking your money out of cash and you're buying a stock. The moment you buy that stock, you're going to watch that account balance going up or that account balance going down. And that's going to happen immediately. You might buy a stock and the price starts dropping and suddenly you just put, you started with $10,000 of a stock and suddenly you're at $9,800 and you're panicking, you're wondering what you should do. Again, that's shaping your tolerance for risk and your comfort investing. But the moment you do put money into an investment, realize it is going to start moving and it is not going to stay right where it was the moment that you bought that stock. That's the idea. You're hoping that it's going to grow. And periodically on your own schedule, whatever that is, you're going to want to review and revise your investment strategy and your investment portfolio. So these are some tips on managing on your own. Now, in addition to that, if you're managing on your own, you're also going to want to take a look at the benchmark. And you're going to want to have some sort of a benchmark on your account. And what I mean by that is here what I have written on this timeline right here. This blue line is the benchmark, as you can see right here. And what we're looking at when it comes to the benchmark is something equivalent of the S&P 500. That's a great benchmark, and many times individuals or investment professionals will use the S&P 500 as the benchmark for how investments are performing. The S&P 500 is basically a collection of 500 of the largest stocks on the stock market. And when people say, how'd the stock market do today? Many times they're referring to how'd the S&P 500 do. And so if over the course of your lifetime, just putting money in an index fund and leaving it alone and letting it grow with the market would return a certain rate of return, if you're managing your investments, you're going to want to compare yourself when you run your illustration. Are you outperforming the benchmark or are you underperforming the benchmark? If you're doing all these tweaks to your account and you're buying and selling and making different trades and you're doing worse than you could have done had you just bought the S&P 500 index fund and left it alone, and let's say that returns a 9% for the year, and after buying and selling and trying to time the market, you end up with a 7%, you're underperforming something that would do on its own. If you're managing your own investments, you're really going to have to pay attention and look at these investments on an ongoing basis. And so have a benchmark and monitor how you're doing compared to that. That brings me to the next part. Are you going to bring in an expert to do this for you? And there's people like Bright Wealth that manage investments for clients all the time. And so if we're going to be managing your investments, we're going to hold ourselves accountable, or our team, the Bright Advisor team, is going to hold itself accountable to a benchmark as well. And every time that they would meet with you to show you how your account is doing, we're going to look at, well, how would it have done had you not hired us and just left your money in an index fund? And then we would show how are we doing compared to that index fund. And hopefully in our client meetings, when we meet with our clients, we're outperforming the index. Otherwise, it makes a very uncomfortable conversation for our advisor. Nevertheless, those conversations are made, everything is transparent, and we're holding ourselves accountable on a regular basis. The Bright Advisor team, when I say we, that's what I mean. And so one thing to consider when you're hiring an investment advisor is, what are their fees? How much are they charging you? They're typically going to charge you between 1% and 2% for that service to manage your fund. They're also going to hopefully outperform the benchmark. And if you currently have an advisor working for you, you might want to ask them to run a comparison of how they're doing compared to how the S&P 500 did, or how have they done compared to the S&P 500 historically with your account. If they've been managing your money for several years now, let's take a comparison against the S&P 500. Also, when it comes to hiring a financial professional, you want to make sure that they're securities licensed. Insurance agents are great for selling insurance, but sometimes some of them represent themselves as financial professionals, like they know everything about the stock market or they know better than the stock market. They're not licensed or have been through the schooling to understand that, and what they're probably trying to do is sell you an insurance policy. Insurance has a role, but it's not a retirement account, it's an insurance policy. And so you want to make sure your investment advisor, your financial professional, has the Series 65 license, possibly a Series 7 license, and or maybe even a certified financial professional. Again, those are some of the common licenses. You're also going to want to check whether your investment advisor is doing active management or passive management. If they're using the word set and forget, that means putting money into it and never looking at it again. They're not doing much work on that. They're probably putting it into something that's not even in the stock market. And so you're not going to get the stock market gains. You might mirror them, but you're not growing with them. And setting and forgetting is not an investment strategy. An active portfolio manager is going to be making trades on your account on a regular basis and doing their best to grow your account. And in fact, I'm going to go ahead and share a small little clip from a recent interview I did with our active portfolio manager who manages all the accounts for Bright Advisor and was in our studio live, and I had a chance to interview Charles Trular, who is the Bright Advisor money manager, and he does all the trades, does all the investments for the clients that put money with Bright Advisor. So let's take a quick look at that interview. So what separates an active trader versus a passive, or normal investment advisor? There's lots of investment advisors in the industry on every corner. What separates an investment advisor from an active portfolio manager or an active trader?
Sure. Well, there's two kinds of portfolios, and one is neither right or wrong, right? It depends on your situation. A passive portfolio is devising a strategy, different allocations. You might put some in stocks, some in bonds. Everyone's heard of that, the 60-40 portfolio, or finding the best things in different allocations to be diversified so that you can do well no matter what the market does. And then you buy those things and you just leave them. And once every 6 months, maybe once a year, you go in there and make sure that they're still there and they're still in the right allocations and the values are still the same. And then you leave it again and you just leave that go. It's not a bad idea to do, especially if you're doing it on your own, for your own IRA. I would recommend that's all you do, because you'll get what the market will give you. You're going to take the risk of the market. You're going to get the return of the market. Instead of trying to figure out and time the market and beat the market, you're never going to do that as an individual investor. So take that passive strategy and use it. It's also what a lot of investment advisors use. They will help you design that passive portfolio. Again, it's neither right or wrong. It depends on your situation. If you like the idea of that passive portfolio and you don't care to look at your investments at all and just leave it and forget it, sometimes a passive portfolio is fine. And they will help you design that. They'll implement it. And then once every 6 months to a year, they will look at it for you and determine if those allocations are still correct and move on from that.
And that means, as on a passive portfolio, that if the market's going up, you're going up with it, but if the market's going down, you're also going down with it, and you just sort of have to ride that out, right? The ups and the downs.
Usually.
Usually, okay.
Yeah, there's really not a passive portfolio allocation that makes money all the time. Or we'd all be in it. We might not even be on this video today.
So you went down the fall with COVID and then back up again.
Correct.
That kind of a thing.
Correct.
Okay.
Well, that explains the difference. So the active management is looking at what trends are happening, what has momentum in the market, what has good fundamentals in the market, what does it look like over the next 2, 3, 4 months, 2, 3, 4 weeks sometimes, and making different adjustments to your portfolio based on that on a regular basis. When you use a professional that does that, we don't use emotions. We have a defined strategy that we use. And when certain equities or bonds or stocks or companies come into that strategy and fit our mold, we will invest in those companies. And a great example of that is absolutely the COVID hit that everybody took last February, March, and April, where the market as a whole was down close to 30%, sometimes even more. If you see the momentum, you had a chance to see that momentum if you know what to look for about 2 weeks before that happened. And we did, and we saw that momentum happening. So we moved out of general market positions in order to protect what we have grown till then. So while everyone else is taking a 30% loss, if you do your active management strategy correctly, you can mitigate those losses. You don't win every time, but if you win more than you lose, you leave Vegas with money in your pocket.
So as you can imagine, you can understand why Bright Advisor favors an active portfolio management and having a professional that does this for a living. They just have such a breadth of knowledge and experience, and Charles is first class and is an exceptional person to be managing the money for your retirement account. So you have your option. You can do this on your own, and if you love doing it, go for it. Just make sure you're benchmarking yourself and holding yourself accountable. If you're going to have Bright Advisor do it for you or another financial professional, make sure you're holding them accountable. And this brings us to stage number 5, which is taking income. So let's go ahead and move on to stage number 5. Okay, so stage 5 is all about taking income. And it's an important stage because there are penalties if you do it wrong. So be sure to pay attention here. One of the keys that's important about IRAs is that they're known as a qualified retirement vehicle. What that word qualified means is that when you put money into this type of a retirement vehicle, the money has to stay in there until you're at least 59 and a half years old. And so that's the first restriction that you really need to be aware of. If you open up an IRA and move money into it, you need to understand that that money needs to be there until you're 59 and a half. So if you're 20 and you're opening up an IRA, put that in your mind so you know that that particular bucket of money is going to be long term. And so you can use other buckets if you need access to that money along the way. Now there are some exceptions when you can access your money prior to 59 and a half, and we'll take a look at those in just a second. The second thing that you want to realize is that your money that goes into an IRA, well, first off, what I want to do is, what if you take your money out before you're 59 and a half? And I see people do this all the time. I want to kind of show you what's going to happen when you do that. So let me give you an example right here. Let's just say you've got some money in your IRA and you want to take $50,000 out, but you're only 40 years old. And let's just say you had, maybe $150,000 IRA balance, and you take $50,000 out. Well, right off the top, you're going to be subject to a 10% penalty. And so that's going to be $5,000 deducted immediately. And so you'll immediately turn your IRA into a $45,000 distribution from the $50,000. Secondly, what you'll do is you'll pay your current tax rate depending on the marginal tax system. And you can see the marginal tax system illustrated right here. What we have is for single filers and for married filing jointly. If you're single and you're taking money out of your IRA, here's the marginal tax system. If you're taking $50,000 out, then that's going to move up into this tax bracket right here, above 40 and below 86. So you're going to be in the 22% tax bracket on some of that money, the 12% on some of it, and 10%. Whatever your effective rate is, let's just say that's 18%. I hope that's not too complicated for you. But if it was 18%, and I probably shouldn't have used that number, let me go with a 20%. That'll be easier. Now you're looking at another 20% of the original $50,000 is going to be another $10,000 that's going to have to be paid in taxes. That's going to come out of the 45, and so that's going to leave you $35,000 left over. So you went to your $150,000 IRA. You wanted to take $50,000 out. You ended up only getting $35,000, but your IRA now only has a $100,000 balance. That's the problem with taking money out early. And I wanted to highlight that so that you're aware of that. Specifically, putting money in your IRA, one of the worst things you can do is take money out early that doesn't fit into one of those exemptions or exclusions. So when it comes to distributions, your distributions are added to your earned income. And so what that means is that if you take $50,000, or let's say you take $100,000 out of your IRA this year, that's equivalent to going out and earning $100,000. So if you just take your after 59 and a half, and you're just taking money out of your IRA, if you're married filing jointly and you take $100,000 of your IRA, just follow right up your marginal tax system, and that's going to put you, it looks like, between these two tax brackets. And so whatever your effective tax is, you're going to have to pay taxes on your IRA as if you earned that money in that year. And if you take that money out early, again, I already mentioned this, there was a 10% penalty on the early withdrawal. So that's pretty much an IRA. Again, just to recap, when it comes to taking the income out, the income that you take out will be taxable if you're older than 59 and a half. If you take that income out before 59 and a half, you're going to pay a penalty, and your income that you're taking out of your IRA will be taxable. Again, unless you follow one of those exclusions. So let's go ahead and take quickly a look at those exclusions, and I'll quickly walk you through them. Now, exclusion number 1 is unreimbursed medical expenses. And so if you have any unreimbursed medical expenses, if you have any health insurance premiums, you can also use money out of your IRA if you have a permanent disability, if there's higher education expenses, if you inherit the IRA, if you're using it to buy or rebuild a home for the first-time buyers. There's another thing called substantially equal periodic payments. If you're going to take your money out for the rest of your life in equal payments, there's a way to get it out. If the IRS levies you, then they can take money out of your IRA for that, or if you're called to active duty. So those are 9 exclusions that if you take your money out for those reasons, you won't have to pay the penalty. You'll still be taxed, but my gut is you don't use your IRA to take money out if you don't have to. Use your savings account for that. Use your investment account for your investment and for your future income. Guys, this is a quick video on IRAs, and specifically a traditional IRA. and how that works for you in your life and the 5 stages that it goes through as you're using it to grow your wealth. So I hope you found value in today's video. Please follow and subscribe to the Bright Wealth YouTube channel. If you have any generalized questions, you can leave them in the comments below. We love answering those. If you have any specific questions about an IRA or your IRA for yourself, click the link below to schedule a one-on-one planning session with the Bright Advisor team. They're happy to meet with you. My name's Scott McLean, and as always, it's not what you make, it's what you do with what you make.